Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that every investor, whether beginner or seasoned, absolutely needs to understand. We're talking about tax risk and regulatory compliance. Now, I know the moment I mention taxes, some of you might be tempted to switch off, but stick with me. Taxes aren't just a side note in investing. They're at the very heart of how much wealth you actually get to keep. You can be brilliant at picking stocks, strategic with your crypto, or disciplined with your bonds, but if you overlook tax and compliance, you're leaving money on the table, or worse, opening yourself up to penalties and legal headaches. In this episode, I'll break down why tax risk and compliance matter, how tax reform directly affects your returns, what you need to know about crypto taxation with a full crypto tax guide for investors, and I'll share some practical strategies to help you manage all of this without feeling overwhelmed. And of course, I'll also point you to some great resources, including a world-class trading platform and a beginner-friendly investing podcast that can help you navigate today's complex financial landscape with confidence. So let's get started. Why tax risk and compliance matter first. Why does this even matter? Well, taxation is one of the biggest forces shaping your net investment returns. We spend so much time talking about portfolio growth, stock picking strategies, or market timing, but the reality is taxes can make or break your gains. Think of tax risk in three parts. Uncertainty. You never fully know how upcoming regulations might affect your portfolio. Complexity, especially if you're investing internationally, across borders or in multiple asset classes. Compliance challenges. This is especially true for newer areas like cryptocurrency, where the rules are still evolving. For investors, tax compliance isn't optional. It's not a box you tick at the end of the year. It's a strategic part of wealth management. The impact of tax reform on investment returns now. Let's talk about reform, because tax laws don't stay still. Governments are constantly changing rates, adjusting policies, and closing loopholes. The impact of tax reform on investment returns can be significant, and sometimes it changes your entire investing strategy overnight. Let's break it down. Capital gains adjustments. If capital gains tax rates rise, your after-tax returns fall. Imagine this. You generate $50,000 in short-term gains, and the tax rate jumps from 20% to 30%. Suddenly, instead of paying $10,000 in tax, you're paying $15,000. That's $5,000 gone, money you could have reinvested. Dividend taxation. Dividends are another hot area for reform. If taxes on dividends go up, dividend-paying stocks become less attractive, and you might see investors shift toward growth stocks or tax-free municipal bonds. If they go down, suddenly dividend yield strategies look a lot more appealing. Cross-border investments. With globalization, a lot of investors hold international assets, but reforms related to treaties or withholding taxes can erode your returns. For instance, if you're a U.S. investor holding European equities, changes in European withholding taxes on dividends could eat into your profits. Wealth and inheritance taxes, and then we have wealth and inheritance taxes. Some governments are introducing or considering them. If these come into play, high net worth individuals may need to rethink their estate planning strategies. The bottom line, tax reform reshapes incentives. Smart investors adapt quickly. Those who ignore these changes, they risk losing out on returns. A crypto tax guide for investors. All right, now let's get into crypto, because this is where a lot of confusion lives. Cryptocurrency has moved from the fringes into the mainstream. But with that recognition comes regulation, and with regulation comes tax obligations. Here's a comprehensive crypto tax guide for investors. Every transaction can be taxable. Selling, trading, or even swapping one coin for another can create a taxable event. If you exchange Ethereum for Solana, you've technically disposed of ETH, and that disposal may be taxed as a gain. Holding periods matter. Many countries differentiate between short-term and long-term capital gains. If you hold Bitcoin for less than 12 months, you may pay a higher rate than if you hold for longer. Mining and staking rewards. If you earn crypto through mining or staking, that's usually taxable as income the moment you receive it. For example, if you mine zero point 0.1 BTC and it's worth $5,000 at the time, you owe taxes on that $5,000, even if you don't sell it. Airdrops and forks. Even free tokens can be taxable. If you receive an airdrop worth $2,000, that's taxable income on the day you receive it. If the value falls afterward, you could still be stuck with the original liability. Reporting and documentation. This one's huge. More and more exchanges now report customer data directly to tax authorities. That means non-reporting isn't just risky, it's likely to be caught. Keeping records of every transaction, every wallet transfer, every fee is essential. International exposure. If you use foreign exchanges or DeFi platforms, you may need to disclose under international agreements like FATCA or CRS. Failing to do so could result in heavy penalties. The key takeaway here? Crypto is exciting, but tax law is catching up fast. If you treat crypto as a gray area, you're asking for trouble. Document everything and treat it with the same seriousness as traditional investments. Compliance as a competitive advantage now. Here's a mindset shift. Instead of seeing compliance as a burden, think of it as a competitive advantage. Why? Because those who manage taxes well keep more of their returns. Let's list out the benefits. Lower audit risk. If you're transparent and accurate, you reduce scrutiny. Better portfolio optimization. Tax-aware strategies like loss harvesting can give you a clear edge. Enhanced credibility. This is crucial if you're managing outside capital or working with institutions. Compliance builds trust. Peace of mind. Honestly, this one's underrated. Knowing you're compliant means you can focus on growing your wealth instead of worrying about letters from the tax authority. Think of compliance like an insurance policy. It costs you time and effort up front, but it protects you against far greater risks down the road. Tools and resources for smarter investing. Okay, let's talk about tools because knowledge is great, but execution is what matters. Trading platforms built for the future markets move fast. You need a platform that moves faster. A world-class, cutting-edge, user-friendly trading platform like Crystal Ball Markets is designed to give you that edge. Whether you're in equities, forex, or crypto, having a reliable and intuitive platform lets you act decisively without fumbling around. Ready to elevate your trading experience? Check out Crystal Ball Markets today. Podcasts that make finance accessible. Education is power. If you want to stay informed but don't have time to sift through endless reports, the Crystal Ball Markets podcast is an excellent resource. It's designed to be beginner-friendly but insightful enough for seasoned investors. Topics cover trading, investing, macroeconomics, and the bigger financial picture. Start listening now to sharpen your knowledge and stay ahead of the curve. Key strategies for managing tax risk. Now, let's get practical. Here are strategies you can start implementing right now to manage tax risk more effectively. Stay updated on reforms. Tax rules change constantly. Follow government announcements, read financial news, and listen to market-focused podcasts so you're never caught off guard. Use tax-efficient accounts. Make use of retirement or tax-sheltered accounts like IRAs for 401(k)s or ISAs depending on your jurisdiction. These accounts protect growth from annual taxation. Implement tax loss harvesting. If you've got losing positions, you can strategically sell them to offset gains elsewhere. Say you've made $20,000 in stock profits, but lost $7,000 in crypto. Selling those losses can reduce your taxable gains. Diversify jurisdictional risk. If you're holding international assets, look into tax treaties. Many reduce withholding taxes on dividends or interest income. Work with professionals. The more complex your portfolio, the more sense it makes to hire a tax advisor who understands both cross-border rules and crypto-specific regulations. Keep meticulous records. Store receipts, transaction logs, exchange reports, everything. Organized records make reporting easier and protect you during audits. Final thoughts. To wrap up, tax risk and regulatory compliance are not just about avoiding penalties. They're about maximizing returns, protecting your wealth, and building a strategy that stands the test of time. The impact of tax reform on investment returns is undeniable. And in the crypto space, having a crypto tax guide for investors is no longer optional, it's essential. By staying informed, using the right tools, and applying proactive strategies, you not only safeguard your wealth, but also give yourself an edge over investors who treat taxes as an afterthought. If you're ready to take the next step, explore the Crystal Ball Markets trading platform for seamless, professional grade trading. And for ongoing learning, tune into the Crystal Ball Markets podcast for beginner friendly but highly insightful conversations about trading, investing, and the financial markets. That's it for today's episode of Financial Market Insights for Traders. I'm your host, Sophia. Thanks for joining me, and I'll see you in the next episode.